Hi everyone, my name is Joshua Aura. I teach IFRS courses at AARO Academy. Today, I would want us to talk a little bit about IFRS 2, share-based payments. This is an important standard that you will need to appreciate, especially if you are a company that is planning or that is already issuing shares to its employees for services rendered. If you have what we call an employee share ownership scheme. Welcome to today's session. Now, what is a share-based payment transaction? A share-based payment transaction is a transaction in which the entity, number one, receives goods or services from the supplier, including employees, in a share-based payment arrangement. Number two, incurs an obligation to settle the transaction with the supplier in a share-based payment arrangement when another group entity receives those goods or services. So most importantly, we have this employee or supplier. They have supplied their goods or services to our company, but we don't plan in this case here to pay them cash. We would want to settle that obligation in our company's shares, right? Or rather, if, for instance, whatever promise we make to them is pegged on the share price, then automatically we shall be required to do accounting on the basis of IFRS 2, share-based payments. So what types of share-based payments do we have? Number one, we have equity-settled share-based payments. Equity-settled. We are settling them through shares. Number two, we have the cash-settled share-based payment. So we are going to give you cash, but the cash we shall give you is dependent on, for example, the share price at that time. Number three is where we have a blended, a combination, transactions with a choice of settlement. So in this case here, this supplier is told to choose. Do you want our company shares or do you want, in this case here, our cash upon, for example, this share price hitting this amount? Vesting period and how to recognize share-based payments. Vesting period is key. Often, share-based payments are not immediate, but payable, say, in 3 years. So I shall tell you as our newly employed CEO that should you make things work in our company, you stay with us for more than 3 years, we shall be able to give you this number of share options at the end of the third year. Then the expense here will be spread over the 3 years. And this duration is what we call the vesting period. So how much do we recognize? So the moment you make a decision that it is a share-based payment that you have, then at the end of the day, you shall have to debit the expense and then you credit equity if you are going to give out company shares in lieu of the payment, or you credit a liability if you have settled for cash to be paid at the end of the third year. So I'm emphasizing again, ladies and gentlemen, that always we shall debit an expense account. And then what we shall credit will depend on whether we are going to issue our ordinary shares or we shall be giving cash at the end of the day, which of course is based on the share price. So I'm repeating again, debit expense, credit equity or liability. Now I have a good illustration here that an entity grants 100 share options on its $1 shares to each of its 500 employees on 1st January 2019. Each grant is conditional upon the employee working for the entity over the next 3 years. The fair value of each share option as of 1st January 2019 is 10. Based on a weighted average probability, the entity estimates on 1st January that 100 employees will leave during the 3-year period and therefore forfeit the rights to the share options. The following occurs, and this is my interest. Note 1. 20 employees leave during 2019 and the estimated total employee departures over the 3 years is 70. So total over the 3 years is 70, so the 20 employees who leave in 2019 is irrelevant for now. So in year 1, which is 2019, I'll take 70 employees as the expected number to depart. And then note 2, 25 employees leave during 2020 and the estimated total employee departures over the 3 years, again, total over the 3 years is 60. So in year number 2, I'll work with 60 employees leaving. And then in year number 3, now I'll work with these 10 employees now leave. This is the last year. So then in 2021, over the 3-year period, the number of employees that will be leaving over the 3-year period on this last year will be the total. So in 2021, I'll take 20 plus 25 plus 10, right? So ladies and gentlemen, if you look at this particular sheet of mine, we have year 1 departures, we have 70, year 2 departures, 60, and then year 3 departures, this is what we have, and you can see I worked with the actuals. So in year 3, I took 20 plus 25 who left us in year 2 plus 10 who left us in year 3. That's great. Now, then after that, I should be able to get the number of employees remaining. So how do I get this number of employees remaining? I know that I began with 500. If 70 leave, so then this 430, as you can see in the formula, it is 500 minus this 70 to get me 430. How about this year 2 number of employees remaining? I'll take 500 minus the 60 who are expected to leave over the 3-year period as that estimate given in year 2. So 500 minus 60 gives me 440. And then we have this 445 being the number of employees, in this case here, that are left in employment. This column captures employees that will be left. Now then, how many share options are we going to give them? Remember, each employee is granted how many shares? Each employee is granted here 100 shares. So then take 430 times 100, it will give us 43,000. All right? So you can see the number of shares that we have promised that we shall be giving to these people. What is their total value? Remember, when it comes to valuation of these shares, we can never keep on having a fair value per share fluctuating. If it's share-based, I'm going to give shares at the end of the day. It's equity-based. If that is the case, then the fair value to be used will be the fair value at the beginning. What we call the fair value at the grant date, which is 10. So then what I need to do is to come and take the number of shares that I have here times a price of 10, which is giving me 430,000 like that. Now, from there, ladies and gentlemen, I'll come and give them what we call the time-weighed values, the time-weighed expenses. This 430 is for year number 1 out of 3. So then I should take 430 times 1 over 3, which in this case you can see in the formula here, we took in this case here, this G6, this cell here, times 1 over 3. That's how we got this 143 like that. This total value of 440 is for those who have been with us for 2 years. So 2 out of 3. So to get this 293, this is what I did. To get the 293, I took this G7 cell, the 440,000 times 2 over 3. This 445,000 is an expense now for employees who have been with us for 3 years. So then it will be here, it will be this 445,000 times 3 over 3, which will still leave me with 440,000. But now remember, if it's an income statement has to be annual. So I need to appreciate that this is cumulative. So then I'll need to come and give them the expense per what year? Per year. Like year number 1, no problem. I'll come and take this 143,333.3. Go to year number 2. So year number 2, what do we do? I shall have to, in this case here, get the incremental. Incremental means that I take this 293,333, which is for 2 years. I subtract the first year's cost. So I take 293,333 minus 143,333. So basically I get 150,000, and I've been able to show you what I did here to be able to get this figure. So I took this cell minus this. This is what I have. So then lastly, we have the last cell here. I will come and take this 445,000 minus the cumulative for year 2. This is how I was able to get this 151,666.7 like that. And then now we'll talk over accounting treatment. So like now in year number 1, of course, I'll debit an expense account. I'll debit an expense account with this 143,333.3. And because I'm going to give them shares, I will credit equity with the same amount, 143,333, being shares issued on the basis of what year? Shares that we issued to our employees, perhaps on an employee share ownership scheme. When I go to year 2, I'll do similar thing. I'll debit an expense account of 150,000, and then I'll be able to credit equity. Ladies and gentlemen, thank you very much. We are getting this particular live, or rather this particular tutorial from AARO Academy, which is a global academy IFRS training institution. One request to you, subscribe to our YouTube channel, like this video, and register for our courses. Thank you very much.